All right, so what's the deal? The market is flying high, everything looks great, but some of the biggest players on Wall Street are getting nervous. You've got this awesome rally on one side, and on the other, you've got these serious warnings. So what's really going on? Let's get right into it and figure it out.
And this is the million-dollar question, isn't it? The S&P 500 has been on an absolute tear, up 15% this year. I mean, that's fantastic for our portfolios. But at the same time, you're hearing the big banks whisper that a fall is coming. So which is it? Is the party about to end?
To really get what's happening now, we have to look at how we got here. It all kicked off in the summer with that massive AI rally, right? Tech stocks just went to the moon. Then, come October, we got a reality check with inflation data showing prices were still a bit too high. After that, we saw another jump after the US midterm elections. And all of that brings us to today, where suddenly the alarm bells have started ringing.
Okay, let's break this down. First up, we've got Goldman Sachs. Now, I want you to think of them as the bad cop in this story. They are all about the numbers, the cold, hard data. For them, feelings, hype, none of that matters. It's all about what the spreadsheets say.
And this is the first piece of evidence they're pointing to. 22.3. That's the market's current price-to-earnings ratio. Now, in simple terms, this number tells you if the market is cheap or expensive. And 22.3, well, that's pointing pretty firmly towards expensive. But the real question is, how expensive?
Well, this is where it gets really interesting. Look at this comparison. Today's ratio is 22.3. The long-term historical average is only 17.8. So do the math. That means right now, we're all paying about a 25% premium compared to what's considered normal. That, my friends, is a classic textbook sign of an overvalued market.
But the risk doesn't stop there. Get this, just 7 huge tech companies are responsible for 60% of the market's entire gain this year. Just 7. These stocks now make up 35% of the S&P 500's total value. Now you can probably see the problem here, right? If just 1 or 2 of those giants stumble, they could pull the entire market down with them. That's a textbook definition of concentration risk.
So, what could actually trigger a fall? Goldman has their eyes on 3 specific tripwires. First, if corporate earnings for the fourth quarter come in weaker than everyone hopes. Second, if government bond yields, which are already pretty high at 4.2%, keep climbing. And third, any new trade drama between the US and China. Any one of these could be the pin that pops the bubble.
Okay, so that was the bad cop with all the numbers. Now let's bring in the good cop, Morgan Stanley. They take a different approach. They're less concerned with the spreadsheets and more focused on the psychology, the mood of the market. For them, it's all about what the crowd is thinking.
And their top strategist, Mike Wilson, pretty much boils it all down to this one sentence: we are at peak optimism. What he means is that when literally everyone is bullish, when the party is in full swing and no one can see anything going wrong, that's usually the biggest red flag that a reversal is right around the corner.
And if you want proof of that optimism, just look at this number, 65%. That's from a recent survey measuring how bullish individual investors are. That's the highest it's been since 2021. You know, historically, that level of widespread euphoria, it's a huge contrarian signal. It almost always shows up right before the market takes a breather.
Morgan Stanley's also worried about something they're calling a quality recession. It's a bit of a weird term, but here's what it means. On the surface, the big economic numbers look okay. Job growth is strong. But if you dig a little deeper, you see that the average person is actually spending less, and companies are starting to see their profits get squeezed. So the quality of the economy is going down, even if the headlines look good.
So you've got Goldman looking at the data and Morgan Stanley looking at the psychology. They're coming at this from completely different angles. But, and this is the fascinating part, they both end up in almost the exact same place. Just take a look at this table. Goldman says there's a 70% chance of a correction in the next 3 months. Morgan Stanley says 60% in the next 6. They're both predicting a drop in the neighborhood of 6 to 9%. The key takeaway here is pretty clear. Both of these giants are convinced that a correction is a matter of when, not if. But, and this is really important, no one is screaming fire here. This is not a call for a massive 2022-style crash. Not at all. They see this potential dip as more of a healthy reset, a necessary cooldown to bring those inflated stock prices back down to earth and a little more in line with reality.
Okay, we've heard the warnings, we've seen the data. Now, for the most important question of all, what does this actually mean for our money? How do we turn all this analysis into a real-world game plan?
Well, both banks are suggesting a pretty similar 3-step strategy. Step 1.
trim your winners. If you've got those tech stocks that have had an incredible run, maybe think about selling a bit to lock in those profits. Step 2. Build up some cash. Having 10 to 15% of your portfolio in cash is like having dry powder ready to deploy when prices get cheaper. And step 3, rotate into value. Start looking for good, solid companies in sectors that haven't shot up so much, like financials or energy.
And that really leaves us with this one final thought. We have seen that this market is being driven by two powerful forces, cold hard numbers on one side and unpredictable human emotions on the other. So the question you need to ask yourself is this: is your portfolio ready for a potential change in the weather?